Is it okay if we begin on time?
Please.
We've got a. Okay, Madam Chair, is it okay if I ask Tyrene to call the roll?
I divert the meeting to you, Mr. Parker.
Thank you. Thank you. Tyrene, could you just call the roll?
Yes. Roberta
And
Abdul Salam,
Present.
Robbie Ash, Stacy Blakely,
Present.
Jim Durrett,
Present.
William Floyd,
I'm here on the call.
Roger Farson,
Present.
Ryan Glover, Frida Hardage,
Present.
Russell McMurray,
Present.
Al Pond,
Present.
Catherine Powers,
Present.
Rita Scott,
Present.
Reginald Snyder, Christopher Tomlinson, Thomas Worthy,
Present.
There are 11 board members on the call.
So, Madam Chair, as you've asked, I'll jump right into the board briefing. I do want to thank all the board members for joining us today in this board briefing. We do have in front of us a need to go through both a process for our board, which will then lead into a public process to share with our jurisdictional partners as well as the public our proposed budget. And ultimately, we will take this in front of the Business Management Committee and ultimately the board, so that effective at the beginning of the fiscal year, we will have an approved budget. We are in a strong fiscal position, partially because of the COVID relief money that's come from the federal government, but I think overall our financial position is very positive. You will hear that. Raj will take us through the operating budget. He will then turn it over to both Kevin Hurley and Larry Prescott, who will take us through the capital budget, and then Raj, and then it'll turn it back to me, and we're going to have a real strong finish, and we're going to talk about, and I'm only going to preview this a little bit right now, what we are recommending or showing to the board. I shouldn't say recommending because there's no action being taken by the board today, but showing to the board where we have some revenues that we believe we need to leverage to support expansion of the MARTA system. It's significant, it's historic, and we should all be excited about the opportunities that these funds will afford us to advance the transit needs within the MARTA jurisdiction. So next slide, please. I'm going to turn it over to Raj in just a second, but this is what we're trying to demonstrate to the board today, and many of these are important. But I do want to just remind us of the importance of the fifth bullet, delivering on the 15th Amendment obligations. While it is critically important that we go through our budget process, I think we always need to remind ourselves, and I know you board members are well aware of this fact, that we are accountable to our jurisdictional partners. We do have an agreement with our jurisdictional members. It includes the 15th Amendment, and that amendment lays out some very important obligations that we have. And I want to assure you that this budget, both operating and capital that's in front of us, allows us to continue to meet those obligations. It's critical that we do. We will someday need a 16th Amendment to continue to have the funds to operate our system in the manner that we are now. So meeting those obligations is really critical to both present as well as our future. So with that, Raj, I'll turn it over to you to take over and drive this presentation. So thank you.
Great. Thank you, Jeff. Good morning, Madam Chair Rita Scott, and good morning, Madam Vice Chair Roberta Abdul Salam, and good morning, all the board members. Thank you for the opportunity to brief you on the fiscal year 22 operating and capital budgets. And as Mr. Parker mentioned, toward the end of the presentation, we'll talk about some new initiatives, something a little bit more strategic than just focusing on the current year needs. On the slide right now on the screen, fifth bullet Mr. Parker spoke to, but let me speak to the one bullet that's near and dear to my heart. That's the third one. As a CFO, I want to say that the fiscal year 22 budget is financially sustainable, not just for this fiscal year, but we want to ensure, and which we have, that it's sustainable over the long run. When I say long run, at least 5 years, perhaps longer too. And it does support updated service levels. As the board members may recall, on April 24th, approximately about 50 bus routes which had either been cut or reduced were all restored, and that will continue into fiscal year 22. And our budget does support that additional service, if you will. And it also advances the capital program, both on the state of good repair needs as well as some new projects. Next slide, please. Here is the timeline. The first one is a board briefing. That's today. And, once we get feedback from the board, we'll incorporate that, and followed by public hearings on May 10th and 11th. And after that, after the public hearings, to the extent we incorporate any feedback we get from that, the final draft of the proposed budgets will be provided to the jurisdictions, and there will be a board committee presentation on May 27th. Following that, it'll be submitted to the board on June 10th for adoption, or the recommendation to adopt. Next slide, please. Next slide. Thank you. The budget does support the strategic priorities of MARTA, which are consistently provide excellence in customer service, deliver on the capital program efficiently and in time, and of course, demonstrate fiscal responsibility. Last but not the least, strengthen the MARTA brand. Next slide, please. Next. Here are some of the key assumptions for our budget. Number one, it does utilize the most recent sales tax forecast we received from Georgia State University. Actually, it's a pretty good forecast, and I'll speak to that as we go through the presentation. We have the economy, the local economy has rebounded very nicely from the, brief recession we saw during the initial stages of COVID-19. However, the fare revenues have not fully recovered. Fiscal year 2022 fare revenues are assumed to be 60 million approximately, and 21 we expect to end with about $44 million of fare revenues. Just to put this in context, fiscal year 19, the first full fiscal year pre-COVID, our fare revenues were about 130 million. So this year, we expect to get fare revenues about a third of what we did get in fiscal year 19. And even in 22, it's going to be less than half. It's going to take at least 3 years at the very minimum to get back to where we were pre-COVID on fare revenue. And the second non-represented employee wage increase is assumed to be 3% on average. And the represented employee increases, which is ATU increases, are consistent with the current contract, which is 3% till January 2022, and 2% thereafter. And the plan or the recommendation is to split the American Rescue Plan funding as follows. The total funding is $284 million, and we have to use at least 55 of that in fiscal year 22 to support our operations, because as I mentioned earlier, the fare revenues are still less than half of what it was pre-COVID. And a small portion of that, about 29, we plan on using for fiscal year 23 for operations, but the majority of the ARP, or the American Rescue Plan funding of $200 million, the goal is to allocate that for capital projects. And finally, the fiscal year 22 operating budget will be at or below fiscal year 21 operating budget. Actually, it's going to be a tad below fiscal year 21 operating budget. I'll go through the numbers as we go through the presentation. Next slide, please. Key thing I want to focus on this is the top box. I know there are a lot of numbers on that. As you can see, the bus, rail, and the streetcar operator levels have not been reduced. In fact, they're exactly the same as they were in fiscal year 21, all three modes. And the bus operator levels in 21 were a tad higher than what they were in 19 and 20. We continue to maintain that fiscal year 22. So there is no reduction in headcount for bus operations. However, I need to explain one of the things in this, the second box. If you look at the service hours or the scheduled service hours for fiscal year 22, based on the scheduled service hours, it does appear lower than what was actually delivered in 2019 and 20. And there is an asterisk there, which means it does not include any what we call the run as directed service. These are all service that would be adjusted as we go through the year based on need, based on demand. So the expected service hours, both hours and miles, will be higher than the scheduled one, but this is what we have scheduled at the present time. No, by no means this means that we're reducing service. We are definitely delivering the service we planned on delivering in 21 and did deliver in 20. And depending on the need, it could be more. We'll adjust as we move along. Next slide, please.
Raj, could I ask a question about
Sure.
that last slide?
Yeah, please.
The streetcar seems to be an outlier for fiscal year 22. It's a pretty big increase over all past years that we were showing on the slide. To what is that attributed?
Can you please go back to the previous slide so we have that for context? Thank you. The head count is still the same on streetcar, which is 12. And this is the scheduled. Again, depending on the need, that could be lower or higher. Right now, that's what has been scheduled. So,
yeah, and if I may, Raj, if I can just hop in, colleague Greenwood here, this also speaks to the fact that we are looking at ways to improve the reliability of our streetcar service and contemplating actually running a third car in service for a portion of the day. So we wanted to make sure that there was some capacity in our revenue planning for that.
I appreciate that, Kali. Does that also include working with the city of Atlanta on turning Edgewood and Auburn into one-way pair?
Well, I mean, we have intention to work with the city of Atlanta, yes, but that intention is not reflected in these numbers. These numbers reflect what we know we can do, you know, with our own resources, and those conversations will continue for assistance from others.
Thank you.
Mm-hmm.
Thanks, Carly, for that. And next slide, please. This is a comparison of our proposed budget revenues and expenses to going back to fiscal year 19. We included 19 because that was the last year pre-COVID, and 20 partial year was affected by COVID. And if you look at 21, the budgeted expenses were about $557.9 million, but we are forecasting significantly lower expenses because primarily because of 425 vacancies. Also, the contracted services, which is mobility services, were a lot lower than we had budgeted, commensurate with the lower level of demand. So, and fiscal year 22 budget is expected to be 557.1. So as I mentioned earlier in one of the slides, which is a little bit lower than our fiscal year 21 budget of 557.9. Next slide, please. These are the various sources of operating revenues, sales and ad valorem taxes, passenger revenues, and the federal formula funds are a little bit different than the CARES Act funding we got. The federal formula funds we use for preventive maintenance, which is your formula, the 5307 funds, and the CARES Act and the American Rescue Plan funding, both of which we plan on using portions of that for our operations. And some of the other transit-related revenues include lease revenues, advertisement revenues, and so on and so forth. Next slide, please. This is just a pie chart which shows what portion of revenues or what source of revenues we use for operations. The biggest source, of course, is the sales tax. About 47% of the operating expenses are supported by sales tax revenues, followed by the CARES Act and the passenger revenues. CARES Act funding is about 58, and passenger revenues is about $60 million. And we also use, as I mentioned earlier, federal formula funds of about $73 million. That's mostly for preventive maintenance, which are operating expenses. And the other transit-related revenues form about 4% at $24 million. Next slide, please. And this is the forecasted growth in sales and the ad valorem taxes. In fiscal year 20, we actually saw a decline of 2.7, a tad below 3% compared to fiscal year 19. But as you can see, in fiscal year 21, the growth over 20 is expected to be 3%, which means we more or less recover all of the revenues we lost during the pandemic or the recession caused by the pandemic. And going forward, the growth is pretty robust. 22, this is Georgia State University's forecast. The forecast is the revenues will grow by about 3.2%, followed by a very robust growth in 23 and 24 of 7.8, 5% respectively.
Raj, this is Stacy Blakely. Question for you regarding the forecasted growth. So 2020 was, we were negative 2.7%, and we were like 3 months into the pandemic. And so here we are, full year into the pandemic, but we're projecting a 3.0% growth. Can you explain that a little bit? Or maybe that's a conversation we have offline? I'm not sure.
Sure. I think if I put some numbers behind that, it may make a little bit more, provide a little bit more context, if you will. Let me go back to fiscal year 19, which is not on this slide now. The sales tax revenues, overall sales tax revenues were $539 million. And that dropped to 524 in fiscal year 20. That's the 2.7% drop you see there. However, this year, we've already seen significant growth in sales tax revenues compared to last year. So the total revenue expected for this year is 540, which is slightly more than what we received in 19. That's why a 3% will bring it back to where it was in 19. And going forward, the economy is doing very, very well, and hence the growth rate. Is there something specific I can answer?
Raj, let me add one thing to that. I believe in fiscal year 2021, the current fiscal year, I think it was August and maybe September. If Kevin's on, he may have the recollection of these months directly. It was before you got here. The Revenue Department, State Revenue Department, who controls this, there were 2 one-time adjustments that were made that were positive, that did sort of overinflate this 3% growth as a one-time impact. Kevin, is my recollection right on that?
Yes, sir, you're correct. There were two one-time audit distributions conducted by the Department of Revenue. I think combined it was around $11 million, but overall, still performing very well for sales tax for the year.
Yeah. So I think, you know, generally speaking, and you know, this is just sort of reacting to your question off the top of my head, Ms. Blakely, is that probably the negative 2.7 is a little bit lower because of those one-time audits that were done, and some of the revenue that normally should have come in 20 was pushed into 21. So the 3% is probably a little bit higher than if they had you know, sent us the sales tax sort of according to the way it was collected. That, you know, so I think your point is somewhat you know, supported by that misalignment that was created by those two audits that were done by the Revenue Department.
Okay,
Sorry,
thank
Roger.
you.
Hey, it's Russell McMurray. Just a question of the extreme growth in 2023 and why that big a difference? And is that, again, I'm not sure I'm clear. Is this being compared back to 2019, or what's the base of percentage of growth, or is that just an economist growth forecast year over year for sales and ad valorem revenue?
It's year-over-year growth. In other words, 23 revenues are expected to be 7.8% higher than 22 year-over-year growth.
And is that from economists? Because I mean, 7.8 is that's a pretty strong number.
It's not uncommon coming out of a recession. You know, we've seen closer to double-digit growth as well, 9-10%. So that's not uncommon coming out of a recession. You know, we had a pretty extensive call with the economists, you know, just to discuss these and some of their assumptions. I mean, one thing that can happen is, you know, 22 growth, if it turns out to be higher, which we believe it would, but I'm just going by the economist number right now, which they are projecting at 3.2%. If it grows higher, then there'll be a higher base, and 23 may not be 7.8, but the numbers will kind of, you know, can change or straddle those 2 years. So.
Yeah, thank you very much. Seeing a lot of, especially around the region, really high sales tax growth as a percentage. So, I mean, that's certainly within line, but it was certainly a big step up. Thanks for the info.
Yeah, just let me add, Russell, to that the methodology that we've historically been using, working with the economists at Georgia State, is unchanged. So you know, there's no new sort of perspective built into this. This is the consistent analysis that we engage Georgia State with, and I think most you know, folks around Georgia, at least the metro area, that are relying on sales tax are using that same group of people.
Thank you very much.
Question, this is Roberta. Roger, do you have a table or a chart someplace that actually compares side by side the previous year to the current year and the future year?
I do.
Okay.
I do. I mean, I have sales tax going back to actually 2004, and the projection goes all the way to 2050. I have all of those numbers, yes.
No, I don't think I need to go back that far, but at least start with 2020.
Yes, I mean.
Maybe 2019.
I do have all of those numbers. I mean, just you know, fiscal year 19, the sales tax revenues were $539 million, and 2020 was 524. That's a 2.7% decline, and 21 is expected to be 540, or pretty much close to the levels we saw in 19.
Thank you, Raj.
Next slide, please. And the passenger revenues is a little bit different story. You know, I touched briefly on this previously. In 19, that was the full fiscal year before, the pandemic, our fare revenues were 130 million and 20, at least about, the last quarter of 20 was affected by the pandemic, fare revenues dropped to about 98. And there is a considerable drop this fiscal year we are in. So we expect the fare revenues to be about 44. That's about a third of what we received in 19. And again, I touched on this a little bit. We don't expect the fare revenues to recover till 2025. So, it's still 2022 will be less than half of that. In 23, again, about 15-20% lower than 19. Same thing with 24, we'll see a modest increase compared to 23. 2025 before we see fare revenues fully recover from the pre-COVID levels.
Hey, Raj, this is Al Hahn, and maybe this is a colleague Greenwood question, but when you look at the actual back in 2019 was 130 million, you're down to 44, which makes sense. I like the conservative number. I think it's maybe more prudent, but I'm surprised we're not projecting in 22 a little higher passenger gate revenue. So I don't know what that was based on. I'm just surprised it wasn't higher. That's all.
Raj, I'll start and then ask you to take over. Some of the confidence in that number, as Raj has said, that our forecast is based on 8 months of actual and 4 months of projection. But we're starting to see, at least on event-driven ridership, starting to show signs of promise with the major sporting events and venues opening up and raising their capacities. So I think we wanted to be sure to be ahead of that curve should it happen. Raj, there's probably more to explain if you wanted to take it from there.
Yeah, thanks, Carly, for that. One of the things, there is a risk. I'll talk about some of the risks for the operating budget, but based on everything we have seen now, how the economy is opening up, it's not the increase forecasted for 22 compared to 21 is not very aggressive. Just about 2 weeks ago, many of the bus routes, about 50 bus routes were restored. And, with all of the events, economy opening up, restaurants are operating at full capacity. We do believe, the ridership will bounce back, but slowly, but it'll bounce back. And that's why, while 22 may look a little bit aggressive compared to 21, we're being very conservative in our forecast. We believe that it's going to take another 3 years for it to completely be back to normal. And again, this is something we'll monitor. If need be, we'll revise the forecast, but this is the best estimate we have at the present time.
But we also have to predict prospective passenger confidence in the safety of being on transit, and that's going to be a moving target.
Absolutely, yes. 23, 24, everything will depend on the next few months, how well we'll do going into the fiscal year 22. That can very well change our forecast for 23 and 24, and perhaps for 22 as well. That's one of the reasons that scheduled service is a lot lower, because if there is a need, if there is demand, we will be adding service. Next slide, please. This is, just to state the obvious, there is no change in the current fare structure, and the last fare increase was implemented about 10 years ago. So it's been the same since then. Next slide. This is a kind of a summary of the application of the 3 separate federal relief funds we received. The first installment was the CARES Act funding, which we received last year, actually fiscal year 20. That was 298, and all of that was applied to the operating budget over 3 years. 20, 21, and 22. And the second installment of the CRISA funding of 33.5, all of that is planned to be applied to the capital budget for fiscal year 22 and 23. We'll go through the details of that as we go through the presentation. And the third installment, which is the most recent one, the 284 in American Relief Plan funding. I touched on the first bullet a little bit, about 55 of that. We plan on allocating to the operating budget in 22, and the remaining 29 to the operating budget in 23, but roughly about 70% of that, or 200 million, the plan is to apply that to the capital projects.
Hey, Raj, this is Chris Tomlinson.
Yeah.
Can you speak to a little bit about why not apply also the CRISA first to the operating budget, since I would assume if you do that as a revenue to the operating budget, if you have surplus, that also could be applied to capital, but at least you would address the operations piece first.
Certainly. I mean, in effect, it's a kind of a zero-sum game. If you apply, CRISA funds to operations, yes, then more of the ARP funds can go to capital. I don't think that's going to change the bottom line of what we need for operations from either from CRISA. There were two projects that were specifically identified, which we believe we can use CRISA funds for. That's a reason, it was split. And we'll talk about the project as we go through the presentation. But in substance, it's not going to change the overall picture whether we apply CRISA funds to operations or ARP funds to the operations. One of the things with CRISA, the key difference is ARP funds have to be committed, I believe, by September 2024. There is a timeline, but CRISA does not have any such expiration. So that is one of the considerations too. We can use the ARP funds in a more time-efficient manner if we apply that to operations without bumping up against a deadline. So that was one of the reasons we said, okay, let's use ARP funds for operations and let's use CRISA, which has no expiration date, to capital budget.
All right. Thank you.
Next slide, please. This is a breakdown of all of our operating expenses. As you can see there, 2/3 of our labor. When I say labor, it's salary, wages, and benefits. Of the 360 million, about 193 salary and wages. Roughly about 32 million of that would be for overtime, and our healthcare we are budgeting at 58.5 million, and the rest towards pension and other benefits. I mean, that is the biggest portion of our operating expenses, followed by other contractual services, which include information technology license fees, fare collection maintenance, passenger facilities maintenance, and those type of costs, and followed by the mobility service, which is our paratransit service. That's about 38 million, or 7%. And there are various other components, for example, fuel and propulsion, small portion, that's about 4%, and our casualty and liability 3%. So the bulk of the expenses are the three ones: the labor, mobility services, and the other contractual services. Next slide, please. I touched on this before. Our non-represented employee raise of 3% on average is assumed in the budget, and the represented employee raise is assumed to be 3%, which is consistent with the contract through January 2022, and 2% in starting February 2022. That again is consistent with the recent MOU we entered into. Last bullet, let me spend a little bit of...
Raj, can I just add here that just to remind people that last year, so this current fiscal year, our non-represented employees did not receive a raise, and the represented employees did receive a 3% raise. So this, normally we are budgeting sort of the same assumption in terms of a raise, but the rationale for this different assumption is really about a decision that was made to not give non-represented employees a raise in fiscal year 21, and we had a contractual obligation to give a raise to the union in fiscal year 21. Go ahead, Raj.
Thank you. Yeah. Let me spend a minute or two on the last bullet on this. One of the things, I went back and looked at the last 5-year vacancy rate. Historically, we have had vacancy ranging from 7.5% to 8.5%. It was more closer to 8.5% this year because of the pandemic. We had, hiring was definitely lower compared to previous years. But even in previous years, even pre-pandemic, we had a vacancy rate of at least about 7.5% or so. So what we have done this time going into the budget is assumed a 3% vacancy savings across the board. This is in discussion with every group based on their hiring plans and all that. Sorry, was there a question? Based on their hiring plans and compared that to historically, how long does it take? As I said, we have roughly about 425 vacancies. And we also have a pretty high attrition rate. In other words, the minute we fill all that, our attrition is also, again, about 7 to 8%. So we hire new employees, we also lose employees due to retirement or other reasons. So, and that level of vacancy is not inconsistent with what I've seen across the industry. Vacancy rates are typically between 7 to 10%. In some areas, it's pretty high. In some, it's about 7%. So what we have done right off the top, we have assumed a vacancy rate of 3%, which I believe is pretty reasonable. And we'll watch how we go through the year. But just to be prudent or careful, although we have assumed a 3% savings across the board, about half of that we have included in the contingency just in case we exceed our own expectations of hiring and all that, and if the attrition is lower than what has been historically, there is a little bit of a cushion in that. Next slide, please. This is a high-level comparison of the budget, from 20 to 22. I'm going to focus on the last of the highlighted line at the bottom. Negative means surplus, actually, which means that's an accounting thing, nomenclature, I guess. When you put something in parenthetical, it's revenue, which means it's positive. Somewhat counterintuitive, but that's what it is. So our 22 budget is expected to be a balanced budget. A $2 million surplus is a rounding. So, and overall, the budget is a little bit lower than our fiscal year 21 budget of 557.9. So, started the presentation with the goal is to have a balanced budget and make sure it's sustainable, and not just in the current year, but going forward as well. Next slide, please. And there are still, there are certainly some of the risks, and this the pandemic, the lingering impact of that. This goes back to the earlier question: will ridership and fare revenues bounce back as we believe they would? Yes, that's based on the current information, current forecast or projections we have, but that's still a risk. Things can go south very quickly, and that can definitely affect our transit ridership and fare revenues, and even the economic uncertainty. Sales tax revenues are going very well; they're pretty robust. However, they're volatile. They are subject to economic, downturns, and fuel prices. Although MARTA is not that much, affected by fuel prices. When I say fuel prices, predominantly diesel prices. The bulk of our fleet is on natural gas, so we are a little bit insulated from that, but that is still a risk. And healthcare costs too. Although we have been able to contain those costs, there is always a risk that can go up. and the pension costs as well, which is largely dependent on the returns of the stock market. We have done very well the last 2 years, and this year we continue to do well, but that can, again, as you've all seen, change very quickly, and those are some of the risks for the operating budget. Next slide. That concludes my presentation on the operating budget. If there are any questions, I'll be happy to answer them, or I'll turn it over to Larry Prescott.
Good morning, everyone. Thank you, Raj. As with every year's budget, we have tall orders to fill. So next slide. So we are tasked to keep MARTA advancing as a state-of-the-art transportation authority while remaining fiscally responsible in providing system-wide projects, expansion corridors, station rehabilitation, and new facilities, as well as utilizing new funding sources, which, as Jeff said, will be covered later on in this presentation. Next slide. So our assumptions are based on active projects, of course, under contract or within procurement, which meet our policy directives as shown here below. We have taken the 220 plus proposed projects and prioritized them based on these 5 KPIs while incorporating expansion and enhancements as well. Next slide. Here's our program structure with the 5 areas of asset classes, which are based on the anticipated FTA groupings under MAP 21. Next slide. Our 10-year capital improvement program structure is broken down in these 5 program categories: vehicles, facilities, maintenance away, operating systems, and non-assets. So the next slide, I'd like to pass it over, play tag team with Kevin Hurley on some of the financials. Next slide.
All right, thank you, Larry. This slide presents the MARTA State of Good Repair 10-year capital improvement program. This is a balanced program which is funded by utilizing a prior year carryover, sales tax, federal and state grants to include CRISA stimulus funds, prior year sales tax carryover generated by the use of CARES Act funds for operations, and debt issues necessary to support the expenditures for the capital program and any debt service related to that program. On this slide, I'd really like to point out the bullets there at the bottom with the asterisk. These are in relation to debt issuance. And I want everyone to understand that the timing and amount of the debt issuance will vary based on the execution of the capital program and the final allocation of the ARP funding. The $200 million in anticipated ARP funds are not shown in this allocation plan. All right, next slide. Now we move from the MARTA State of Good Repair 10-year plan down to focus on FY22. And this table presents the sources and uses for the MARTA State of Good Repair Capital Improvement Program. Please note the beginning balance is a $20 million carryover from prior year sales tax. And then we follow that by funding sources that are identified in FY22. These sources are from sales tax, federal grants, CRISA stimulus, prior year sales tax carryover, interest income, and bond proceeds. Those will total $622.3 million, and combined, the total sources of funds available to be used for capital to support the capital program in FY22 are $642.3 million. Then we step down one more layer to the project uses. The FY22 capital improvement program totals $481 million and anticipated debt service of $158.2 million for bonds that have been previously issued, for a total capital expenditure of $639.2 million. That would leave us a year-end balance of about $3.1 million to carry over to FY23. Next slide. Likewise, as compared to the operating budget, we are showing a pie chart here for the FY22 sources of funds, $642.3 million. And this gives a good picture of the magnitude of the sources of our funding. Note the largest are sales tax revenues, which are $236.5 million, and then followed by debt issue proceeds comprising about $220 million. Subsequently, we also have the federal and state grants, inclusive of CRISA and MARTA standard grant program funds, which provide $16.5 million and $67.1 million, respectively. And then the final sources are the prior year sales tax surplus generated by the use of the CARES Act funding on the operations side, and that's $81.7 million, and interest income of about $500,000. This is the total of the 642.3 to be used to support the capital expenses. Next slide. Here are the capital expenditures, primarily by asset class, as Larry referred to earlier. The total is $639.2 million of anticipated expenditures. And you can see here the largest is focused on the systems asset class, followed by the vehicle asset class and the facilities asset classes as three of the largest. We also anticipate using $84.5 million for maintenance of way projects, and for non-asset projects, and maintenance of way projects about $21.5 million. Debt service is the only item that isn't one of the asset classes, obviously, and we're anticipating $158.2 million to be utilized to support debt service. And the total expenditures, once again, $639.2 million. And with that, I'll turn it back to Larry, and he's going to talk a little bit about some of the major projects incorporated into the program.
Next slide. All right. So here are our top projects by cost. So as you can see, there's a good mix of categories as discussed, covering vehicles, rehabilitation, various systems, replacements, and upgrades. These consume approximately 56% of our FY22 capital budget, which leaves the remaining funds to cover the other 200 plus projects where possible. All right, back to you, Kevin, on the next one.
Okay, next slide. This slide presents the MARTA City of Atlanta 10-year capital program. The balance program for the City of Atlanta utilizes a prior year carryover from the City of Atlanta reserve funds, sales tax, federal grants to include potential grants, as well as future debt issues to support the 10-year capital expenditure and 10-year capital expenditure program. You'll note that debt issue is not in the near term. We won't see any debt issues in this current program till FY26. Next slide. Likewise, we now move from the 10-year plan to focus on FY22 for MARTA City of Atlanta. This table presents the capital sources and uses for the MARTA City of Atlanta effort in FY22. And I wanted to take a minute here to walk through the beginning balance calculations and how the reserves are grown over time, have grown over time. And so please note the beginning balance that we had in FY22 FY21 of $97.3 million. Within FY21, we anticipate receiving about $73.4 million of sales tax proceeds from the City of Atlanta half penny. Of this, we split that, and $36.7 million will be used for existing operations, and the remaining $36.7 million is shown here going into the City of Atlanta reserves. During the course of the year, there are projects in the MARTA State of Good Repair capital program that do expend funds supporting more MARTA City of Atlanta currently. And so we reduced that by $11 million to support those projects. And then to fund streetcar operations, we've reduced it an additional $5.4 million. So that would provide us with an estimated year-end balance of $118.4 million in City of Atlanta reserves that can be used to support the FY22 capital program. So that's just kind of a standard walkthrough of how we look at those throughout the year and then apply the sales tax to the reserves and then netting out any expenditures. The next segment shows the funding sources that we anticipate in FY22. They include sales tax of $29 million and potential federal funds of $4 million for a total of $33.6 million. And that brings the total capital funds available to support the More MARTA City of Atlanta projects to $152 million. The uses program for FY22 are $50 million in expenditures and no debt service, as no bonds have been sold to support the City of Atlanta projects as of yet. So the total capital expenditures are $50 million, and that would leave us with $102 million at the end of fiscal year 22 that would be rolled forward to be utilized in FY23 and beyond. And with that, I'll turn it back to Larry. Next slide, and he can talk about the City of Atlanta projects.
Kevin, I had a quick question on that slide.
Yes, sir.
I just want to make sure I follow. So like the $5.4 million deduction from reserves for streetcar operations, does that mean
yes, sir,
5.4 was taken out of reserves and rolled into 22 operations to cover that?
That would be in 21 operations that would cover that. If you see the FY22 sources where it's showing 29.6, we would have removed an estimate for the streetcar operations as well as the project forecasts for the projects that are showing the negatives, up there above 11.0 and the 5.4.
Okay. So my only question on the operations, if 21 has a net surplus in operations, does there have to be a deduction from the city's reserves, or streetcar operations considered, is that done separately than the operational agency-wide operation budget, if that makes sense?
Yes, sir. It's treated separately as from the agency-wide. Yes, sir.
Gotcha. All right. Thanks.
Yes, sir.
Next slide. All right. Looking specifically again at the FY22 only More MARTA program ATL budget projections, these projects have been scoped to fit within the allocated fiscal year budgets. For reference, the Capitol Avenue Summerhill BRT project just started final design. We are currently in preliminary design for Streetcar East and the Bankhead Station platform extension. And we are transitioning from preliminary engineering to final design on the 5-point station transformation and the Cleveland Avenue and Metropolitan Avenue arterial rapid transit projects. The remaining projects are in planning or concept. So the next slide, turn back over to Kevin for the More MARTA program for Clayton County.
Okay, this slide is similar to the other two 10-year plans, but it's specifically for the Clayton County 10-year capital program. The balance program also utilizes a prior year carryover from the Clayton County Reserve Funds, sales tax, federal grants to include potential federal grants, as well as future debt issues that will support the capital project expenditures over the next 10 years. Next slide. And likewise here, we'll move down to FY22 for MARTA Clayton County. This table likewise represents the sources and uses to support the capital program for Clayton County in FY22. We use the same methodology to derive the beginning balance for FY22. And I'll walk through that quickly. Beginning in FY21, there was $124.3 million, $55.6 million in proceeds from the Clayton Penny, of which $27.8 million is used for operations, with the remaining $27.8 million going into the reserves. And also during the course of the year, there are some projects that are cause a reduction in the reserve, and we anticipate by the end of FY21 that $4.8 million will be reduced for those projects. And then we add back the investment income of about $1 million, so it results in the FY21 ending balance in the MARTA Clayton Reserve of $148.3 million, and that can be used to support the projects going forward. The sources for FY22, we anticipate $28.4 million in sales tax, 13.7 in federal funds that are awarded, and 6.7 in potential grants, bringing the total sources in FY22 to $48.8 million. And then combined with the beginning balance, that leaves us $197.1 million that are available to support Clayton projects in FY22 and beyond. As you can see here, the FY22 Clayton project projections are $60 million, and likewise no debt service because bonds aren't required at this time. So a total anticipated use of $60 million, which would leave us $137.1 million to be used for future projects. And I'll turn it back to Larry to talk about the Clayton project uses of funds. Next slide.
All right, thanks, Kevin. Here again, specifically looking at the FY22 only MARTA program for Clayton County. These budget projections are, again, scoped to fit the fiscal year budget as we discussed above. All these projects are currently in planning or transitioning into preliminary design. So that wraps up the capital program, and I'll turn it back over to Jeff. Next slide.
So thank you, Larry and Kevin. Good explanation around our capital program. I want to kind of take a little pause here and talk about some future funding options that we've been focused on for quite some time. This is an effort that I've been focused on trying to really put our hands around several financial issues. It's something that Raj has jumped right in and focused on, and I really want to make sure that we're all recognizing that what we're about to talk about is really a significant, and I would say historic, change to what and how we have been programming our operating dollars historically. So I really want to take just a moment to step through some little bit of a historical perspective of how we got to where we are, so that we can appreciate the significant change that we're we're wanting to begin a good conversation with the board around these priorities. So if we think back to the construction of the MARTA system from 79 to 99, we began construction, as we know, back in 79. Larry would be embarrassed to say that he was the resident engineer in 1999 on the North Line extension when we built the last of our last station, North Spring Station. And at that point in time, 20-year period, we were using half of the 1 cent sales tax leveraged against a really strong position with the federal government, with 80% federal funding leveraged that allows us to leverage the 20% local funds that we have. And during this time period, the three jurisdictions, City of Atlanta, DeKalb, and Fulton County, literally put forward billions of dollars of sales tax of local investment to build and operate the system. And I think that we should all also appreciate that the MARTA board and jurisdictional partners at that time really confronted, significant political and financial issues, but saw their need to build a system as a whole, tried to look past those jurisdictional focuses and built a real efficient and effective system that has been serving metropolitan Atlanta for 40 years, since 1979 as we built this system. So we're so fortunate to have inherited this system that we know today. So if we think about what happened post 99 of opening the last station, we as an agency made a decision that we needed to retain the entire half cent, and back then there was a statutory obligation to split our sales tax 50-50 between operating and capital, and we made a decision that we needed to allocate the half of the capital, half of the allocation that funds the capital program to supporting the existing system. And what ensued was that we stopped expanding the system, and we all recognize the the angst that's created over a number of years, and the desires by us and by many others that we could continue to expand the system. And if we continue to look forward, another significant incident that happened was the region, the nation was hit by a significant recession back in 2006, 2007. We all saw that personally with the value of the houses that we owned, but we also recognized at that point in time that there was just a very, very rapid and significant decline in sales tax revenues. And MARTA, the MARTA board, staff here at the time, many of whom are still here, dealt with those real issues of service cuts and dealing with the lower availability of funds to operate the system that we have. But we came out of that strongly. The board focused the agency, and Keith Parker, the former CFO, really focused on that recovery. We made a collective decision to focus on building a reserve account. And that reserve account, since coming out of that recession, has continued to grow significantly. And I want to just point out that when we're talking about this reserve account, it is the reserve account that is separate from the City of Atlanta, MARTA City of Atlanta half-cent sales tax, and the portion of the Clayton County MARTA program that the 14th Amendment, when Clayton County joined the district, that we've separated out. So the what I would call the unrestricted the unrestricted reserve account has continued to grow. It's grown significantly. In fact, in recent history, it's getting ready to double. And what we've been focusing on internally is looking at what we should do rationally with that reserve account, making sure that we're managing the reserve account to maintain and avoid risks in our future, and recognize that it is simply, in the opinion of staff, growing too fast, and that we have an opportunity to refocus that money in a way that can significantly and positively impact the MARTA jurisdictions. I'd also want to point out that we've made significant strides over the past couple of years. Want to, remind the board members who were here and mention to the newer board members that we quite frankly struggled with getting a 15th Amendment passed. We were successful with that about a year and a half ago, right before COVID-19. And that created about just over $11 billion of revenue in our future, allowing us to continue that 1 cent sales tax for a number of years to come. We've also had a very recent another success, and that was working with the governor and the General Assembly for first to create a sales tax that was intended to fund transit projects, and that was done through the Uber and Lyft sales tax. And then this year, we worked very hard, and including the support of many of the board members and staff, to make sure that not only was that sales tax focused on important transit projects like Bankhead Station, but we also found an opportunity to create and cement that funding source into a constitutionally protected transit trust fund, so that the proceeds that pre-COVID-19 were expected to be about a $40 million a year are protected to invest in transit projects, similar to what GDOT has with the gasoline tax. So we're excited about these achievements. Let's go to the next slide. I'm going to ask Raj to step us through what we have laid out. I think this is rational and conservative, but the big historic step forward that we're articulating is to be able to limit the reserve accounts, the growth of the reserve accounts, use that money that has been largely been a excess in our operating budget, leverage that in terms of bonding, using our excess reserve accounts to create additional funds, and ultimately have, and Raj will step us through all these numbers, but just over $500 million of locally derived sales tax funds that we strongly are recommending that we focus on capital programs focused around expansion. So Raj is going to step us through the funding sources, the options that we have, how we can leverage this local sales tax to ultimately bring somewhere between $1.6 and $1.8 billion available of new funding sources for our high capacity capital projects and continuing to focus on the expansion of the MARTA system. So Raj, I will turn it over to you to kind of step us through this one slide.
Great. Thank you, Jeff, for the background. I mean, there's a lot of information we've tried to distill into one slide here, highlight some of the key themes and concepts. One of the first things I focused when I joined MARTA about 3 months ago was to look at the overall financial picture, not just how we are doing or would be doing this fiscal year, but in the longer term. And part of that exercise was looking at the reserves, the operating reserves, and what is the right level of reserve we should have. I mean, there are 3 different analysis test criteria I focused on. One, what is that statutorily required reserve level? That's one. The second thing is about what is the best practice? What do our peers in the industry do? And the last one is, what are the strategic needs and priorities of MARTA, and how does the reserve play into that? So let me walk through the first box on the left, if you will. So on the statute, what is statutorily required? The MARTA Act says that we have to maintain 10% in operating reserves. That's 10% of our previous year's operating budget revenues. That is approximately $55 million. Again, these numbers are all approximations. I've rounded them to millions, so they're not precise, but that's just to get the point across. So it's 55. And the second thing, what is the best practice? The Government Finance Officers Association, they say the best practice is to maintain an operating reserve equal to 60 days of cash flow needs, or about 16.7% of our operating expenditures. And that translates to about 95 million per MARTA. And the last one, it's very, very conservative. There are some not-profit organizations, they suggest that, we should maintain, or entities like us should maintain about 25% of our annual operating expenses in reserve. So that's about 140 million. Well, I mean, other than the requirements in the MARTA Act, none of the other things are hard and fast rules. They all depend on each organization, its needs, its strategic priorities. I mean, determining what's the optimal reserve level, it depends on many different factors. Our reliability of our operating revenues. In our case, it's primarily sales tax revenues, which are volatile, subject to economic, downturns. Fair revenues. And, so, which is, the impact of natural disasters, we saw that our fair revenues plummet by over 2/3. More recently, we're still living through that. And, what are the strategic goals and priorities, and as well as the state of good repair needs, where are our assets, what level of investment do we need to make in our assets to keep them running, keep them reliable, and keep them operable over the next 15, 20, 30 years. So all of these factors go into that to determine what is the optimal level. And again, the last bullet on the left box, that is kind of stating the obvious, if the reserve levels are too low, we are going to be very severely impacted if there is a downturn, that would result in some unpleasant consequences such as reduction in service, furloughs, and all that, which we want to avoid. So the reserve is there to make sure it's a rainy day fund. So if something like that happens, we are protected. But at the same time, if the reserve levels are too high, which means it's like, let me give an example, not a commercial or an organizational example, even on a personal level, what is the amount of money we should have in our checking account? The rule of thumb is, you lose your job, it takes about 6 months to get another job, so you need to maintain about 6 months. So for an organization, it's a little bit different. So it's not, somebody with really advanced skill sets can get a job in 2 months, may not need a 6-month reserve, or somebody who's not very skillful, they need a little bit more time. So it depends. It's not, the one size fits all. So I went through the analysis. One, the MARTA Act requirement, as I said, it's about 10% of our operating revenues, which is 5 million. And the fair revenue mitigation is, as we have seen, fair revenues plummet recently. I mean, it's kind of a slow and painful recovery back to where we were. And, it's going to take about 3 years to get back to where we were, at least. So add another roughly 8 to 10%, that's $50 million of overall operating expenditures, and 50 million is closer to half of our fair revenues, a little bit less than that. And the sales tax, we also saw the sales tax receipts decline about 2.7%. Yes, there was some one-time events, but overall 2 to 3 or even 4% decline in sales tax revenues is not uncommon. So tag on another 20, which is roughly about 4% of our sales tax revenues. So we come up with an optimal reserve level, if you will, of 125 million. yes, although the statute requires we maintain 55, I think it's kind of prudent to maintain about 125. And this is not a static number. I mean, this number needs to be constantly reviewed each year. It needs to be reviewed and adjusted, if need be. I mean, the first one, the MARTA Act requirement, of course, that number will change because once our budget changes, 10% of our budget, so the number will not be 55 constantly, less or more. Likewise, the risk from fair revenues, as we slowly start to recover from the pandemic, the risk is a little bit lower, so maybe we do not need that much. But anyway, at the present time, this is kind of what we believe is the optimal level of reserve we should have. It's about 125. Moving on to the blue box on the right top. This fiscal year, we expect to end with about roughly $355 million in reserves. Again, largely because of all the CARES Act funding we received, which kind of helped mitigate the loss in fair revenues, and a pretty quick recovery on the sales tax revenues helped us. Last but not the least, the stock market has had two very good years now. 19, 20, and 21 is turning out to be pretty good as well. So we go through on our pension funds, we go through what's called a GASB 68 adjustment to recognize some of the gains on the investments, which would reduce our contributions, if you will. So we had a pretty, robust stock market that also helped. So all these three factors, the stimulus funding, quick recovery of the sales tax, and the investment returns help, increase our reserve to roughly about 355 by the end of this fiscal year. I think in the capital program presentation, Kevin and Larry Prescott, touched on this. Of the operating budget surplus of the reserves, we plan on using, the number they used was 81.7. I've just rounded that to 80 here. We plan on using about 80 for our capital budget. So 355 less 80, and the less, they suggested that the optimal reserve level of 125 leaves us with about $150 million available for expansion or future capital programs. That the current forecast we have on sales tax growth is pretty robust. We had a bit of discussion on that. Not only do we expect the sales tax to grow by about a little over 3% in the coming year, fiscal year, but to grow more robustly 7.8 and 5% over the next 2 years, that's 23 and 24. So we believe this is a pretty conservative estimate. We will have another $20 million per year surplus in operating sales tax revenues against which we can bond. So 20 million per year, 30-year, we can 30-year bonds in an amount of roughly about 360. So add that to the current reserve level, which we plan on, ending the fiscal year with 150, 360. So we would have $510 million of additional sales tax revenues available for a capital program. These are not new sources from existing sources, what we would have available for a capital program. And the last box at the bottom on the right, the yellow, the gold colored boxes, add the 510 to the ARP funds, that's the American Rescue Plan funds of 200, which we plan on using for capital, and the CRISA funds of 33.5. The 510 I've already touched on. Leverage all these three sources, which we have or would have, with a couple of different sources of revenues. The next one is the state transit fund. We conservatively estimate about $40 million going into this transit trust fund, if you will, and we take a fourth of that, 25% of that, $10 million per year for the next 10 years. That will be another 100. And local SSDI, the special service districts, and the TOD revenues, again, this is an order of magnitude we expect to generate over the course of next 5 to 10 years, approximately about $250 million. So we get a subtotal of about roughly $1.1 billion in sources of available funding. Leverage that with FTA matching funds. I have a range here because some of them we can get about 40% of FTA matching fund. For some project, it could be 50%. So it's a range. So the range is anywhere from 500 to 725 million is what we can expect from FTA for these capital projects. So in total, we would have approximately 1.6 to 1.8 billion of new sources of available funding, which could be used for regional high priority capital projects to advance them, to support them. With that, let me turn this over to Jeff Tier. I think you're on mute.
Yes.
Sorry, I was on mute. Let's bring up the next slide. And so what we've done is recognizing that the conservative approach that we've had to our reserve accounts, to our operating budget, leveraging that to create an additional local funding source, recognizing that our real estate assets can generate money that we can bond against. This is something Jacob has been talking about. Recognizing, and I'm sort of moving across this top column, recognizing that the state has allocated a new funding source that we believe we can be competitive in convincing the governor and the legislature to allocate funds directly to MARTA's expansion projects. Also recognizing that we need to work with our jurisdictional partners for them to create local funding sources, to have a skin in the game for advancing projects. We also have available federal funding sources that we've talked about, and ultimately the local funding sources can leverage federal funds. So what we've done is we've put together a potential allocation of capital funds to expansion projects. It's really intended to spur a conversation with our board. It's our recommendation, and we'll begin to do this, is reaching out to the board members and focusing on the groups of the board members by jurisdiction to talk about and understanding the priorities of the jurisdictions that they're appointed by. But also recognizing that, as I talked about a few minutes ago, that we're building a system which is part of a whole, and that we need to recognize this investment needs to support the larger system, which is MARTA, and not just the individual needs of a particular jurisdiction, but also match the overall needs of our region. So we put together this. I will say that I think it advances the need to grow transit in this region in a substantial way. Many of these projects are an early concept, so we obviously don't have engineering defined costs for these projects. We need to advance these things, but I think that this beginning of a conversation of priorities really recognizes a couple of items. One is that we need to continue and focus on equity. I think that the experience of getting the 15th Amendment passed was a clear recognition that our jurisdictional partners are really focused on equity and making sure that there is an equitable distribution around our jurisdictions to advance their priorities. We also should recognize that we have some new funding sources, like the City of Atlanta, like Clayton County joining MARTA, where we want to enhance those expansion projects and make sure that we're doing that in a way that continues that. I think we also need to recognize that we have some great, strong opportunities that we don't want to miss the opportunities, and that's to leverage our transit dollars around the state's investment in the managed lanes. And the two projects, really the three projects that I've put onto this chart are Georgia 400, which we're all really aware of, the funded project of the I-285, making sure that we have both MARTA local money, but a need for the local jurisdictions to leverage their dollars, either with a new sales tax that could be leveraged through House Bill 930, or the potential of creating special service districts like the city of Atlanta has done to fund the Beltline Trail is another funding source, and we see that as an important augmentation of what we MARTA could do to fund with our funding sources, and ultimately leveraging dollars. And then the other one that's on here is we also recognize that the DOT and SRTA are beginning to look at and plan. My understanding is I don't believe it's funded, but I-20 East managed lanes is something that is being studied at least, and I believe we want to have some amount of money to make sure that we can keep up with the DOT in terms of laying out what we believe would be the priorities of how to build express lane transit along that corridor. So there's a focus there. We recognize that transit centers are important to our jurisdictions in Clayton and DeKalb County. We have some operational improvements that are largely leveraging signal prioritization to make our existing bus service work more efficiently. I think that the experience of lower ridership, we've got to really focus some efforts around improving our existing bus service to make that more efficient. And these operational improvements that we've laid out can be key strategies in that. We also have a recognition of funding projects in South Fulton, either South Fulton Parkway or Roosevelt Highway, a recognition of a priority in South Fulton that was laid out in the Fulton County Transit Master Plan to improve transit along those corridors. South Fulton, which is really a growing corridor, and Roosevelt Highway, which is an incredibly rich transit corridor already. And then we also, I think, have an opportunity to work with cities in South Fulton and parts of unincorporated DeKalb County. The airport is looking at a first last mile connectivity system that would integrate with our MARTA system, serve many of the communities, including Mountain View and College Park and East Point, provide first last mile connectivity. There's a recommendation here to consider a financial and operational feasibility study to see if this is a technology that could be incorporated into the MARTA system to ultimately serve less, emerging and less dense parts of the region, and ultimately come up with a funding strategy to see if this could be built. But I think it's important that this system, which is proposed to exist within the MARTA system, that MARTA is clearly leading the efforts to define how that would integrate and operate with our existing system. We also recognize the importance of our existing capital program and want to make sure that we have enough money to make the substantial improvements to our MARTA stations, the projects that we have in place in terms of improving the projects. And finally, we have a recognition that we need to continue to invest in traction power substations, a key need. These are two. The traction power substation is intended to use the CRISA money, as well as the improving our ability to deliver the transit centers in South DeKalb and Stonecrest. So this is a lot of information that you have in front of you. It's not meant to be a plan that we're putting in front of the board to approve. It's instead a plan that is, I think is a very, very rational potential allocation of the substantial available MARTA sales tax revenues, TOD revenues that we believe we have, leveraging that against state and local funds, and ultimately getting new funds from the federal government through the CIG program, and ultimately being able to continue what we had been doing for 20 years, building a system. And now, you know, I think we're in a position financially to bring a significant amount of money to the table to ultimately expand our system in a way that meets the needs of our jurisdictions. But I think as importantly, allows the board to think about our system as a whole and how we should invest in that whole, and ultimately grow the system to better serve the MARTA jurisdictions as a whole, and ultimately grow transit ridership in the communities that we live in and that we work in. So a lot of information. We're at 11:30. Don't want to hold people over. We will begin at the very least a conversation with the board members by jurisdiction to talk about this. I think this will be part of a conversation that we need to have with the ATL, that Chris Tomlinson and I are working with, having a conversation with the ATL and the ATL board and some MARTA board members to talk about the allocation of ARP funding, the 5307 funding there, and how this, I think, really satisfies many of the desires of the ATL and the ATL board to make sure that we're focusing on regional priorities. So apologize, we've gone over a few minutes. There may be questions about this, but I just want to separate out these last two slides. We did present to you the budget that Raj and Larry and Kevin presented, and then these last two slides are really the beginning of a conversation. We're not baking this into the approval of the budget. We see a conversation happening over time that starts with the board, extends out to our jurisdictional partners, and ultimately set some priorities to expand transit. I think that this is something that's important to me, and I know important to all of you. So with that, we will turn it back over to the board and see if there's any questions. We're more than happy to stay a little bit longer, but both with this and the budget presentation that we've just given, there will be a lot more opportunities to discuss this in detail. So, Chairwoman Scott, I will turn it back to you. So thank you.
Thank you, Jeff. Thank everyone for the presentation. Are there any additional questions regarding the presentation we just viewed?
I'd just like to thank Jeff and the whole team. This has been an excellent presentation, and I really appreciate the clarity.
Thank you.
Good morning. This is Katie Powers. Number one, thank you. This was great. I appreciate it. And I should have asked it at the time, and this is not about the last two slides, but thank you for that as well. I think it's slide 34. I know that we've got, the FY22 anticipated budget. Do we have an anticipated completion date when that's going to start, bringing in revenue and being open to riders? As an example, I think the first one may have been the Clayton County high capacity transit.
Yeah, Larry, can you talk about the dates of that? We are beginning this year the environmental clearance for that project. We can, I think, reach out in detail about that, but we do have some significant decisions to make about how much of that corridor needs to be dedicated lanes, which will impact the cost of the project. And I think, Larry, where do we stand with that timing of that project? Or Heather, are you on? anything that you could share that would help answer that question. But I think in detail we should come back to you and Roberta Abdul Salam with some more details about these projects, so we can do that. Any comments, Larry or Heather?
Yeah, we're in the planning for both those right now, and we got another year to go on that before we even get into design. It's looking like construction start is late 23 and 24, depending on the corridors we choose, and depending on those environmental reports that we get.
Okay, thank you.
Madam Chair, may I ask a question?
Yes, madam.
I wanted to just ask staff again. I requested it during our last full board meeting, but I would really like to have a copy of the full budget. If somebody could remember to do
Rod,
that.
we do have a larger piece of information that is going to go out soon after this meeting. That's consistent with the information that you would have received last year. Raj, any updates on that?
Jeff, let me just jump in. I'll answer that. The hard copy, the full documents will be coming in time for the May committee meeting.
No sooner, so we can have time to review it.
Okay.
Not any sooner.
Well, a week out from the May committee meeting, which is May 27th, is that sufficient?
I guess it'll have to be.
We can email it to you this week if you want to go through it. That's fine.
Well, I'm an old stickler with those other little details, and having gone through budget after budget after budget for the state of Georgia and the legislature, I'm just kind of used to that. I'd like to see the whole picture.
All right. We'll get it to you. Yep.
Excuse me, Melissa, are you saying that when you said it will be in time for the meeting, are you sending us hard copies?
Hard copies go out a week before the May committee meeting, but they can go out sooner if that's the will of the board.
No, I'm asking, the question is, it will be a hard copy sent to our
It will be a
residents?
hard copy. Yes, it will be a hard copy.
Thank you.
Madam Chair, this is Stacy Blakely.
Yes, Blakely, go ahead.
I'm in agreement with board member Abdul Salam in regards to getting the actual budget with the line items. I would like to see that sooner than later as well. And also, and I'm not sure if this is a Jeff or Melissa question, but just clarification going back to the capital budget highlights, page 20. So am I clear in that there's no allocation in the fiscal year 22 budget for anything in South Fulton with the exception of College Park Rehab Station, the College Park Station Rehab?
No, it's just not one of the larger projects.
Yeah.
That's all.
So that's the only project?
No, that's not the only project that has money allocated for FY22. It's just that the money for Roosevelt and South Fulton just isn't as much money as the others, and so there's a limit to the number of things you can put on a page. So we're going to do also one pagers by jurisdiction so that you can see everything in FY22 that has capital money beside it. So you'll see all those projects.
Madam Chair, if I may.
And will that be with the, I'm not finished. So will that be with the information that you send out regarding the budget, or will that be a separate, okay. All right, thanks.
That will come with the budget. Yep.
Okay, thank you.
Mm-hmm.
Go ahead.
Thank you, Madam Chair. Ms. Blakely, I apologize for stepping on your toes. I thought I was, to follow up on the request you just made, and I think the point Jim made was, first, I want to express my appreciation to staff for doing the hard work to put us in a position, I think, to take advantage of what's going to be, hopefully, once in a couple decades opportunity to have, I mean, it's been a long time since the federal government increased its infrastructure spending. There's a decent chance that they're going to do that this summer and fall. and turning over every couch cushion to see where we can generate or find additional funds to use to leverage what will hopefully be generous ratios on local matching makes all the sense in the world. It is incredibly important that we be thinking creatively in maximizing the Atlanta region's opportunity to be ready for this thing, if and when it comes. And even if it doesn't come, it'll still be useful to know how much money we actually currently have to spend and can do so. But to Ms. Blakely's point, and I think up to the Clayton members, and speaking on behalf of the Atlanta members of the board, I do think it would be useful if staff were to put together those one-pagers that Melissa just mentioned, and maybe set up an opportunity for delegation meetings with staff so that we can ask questions, because I know we're all interested in the whole system, but we're also particularly interested and likely to get questions from our appointing authorities about what does this mean for us. I think that was a really big vision we just saw. And it's going to take us a while to digest it. But if you can help, at least from my perspective, me dial in on what does this mean in the city of Atlanta, that would be really helpful to me. So meanwhile, thank you, and I appreciate it.
Yeah, absolutely. So two things that we will be doing. So there is a need to get our budget approved around one-pagers as to what the projects that are included in the capital budget that we are proposing and seeking your approval, and then the details of the overall operating capital budget. We will be sending that out as Melissa has committed. We will get that information out as quickly as possible. Separate from that, we will be working with each of the board members by jurisdiction to talk about the opportunity that Mr. Ash was just referencing to leverage all of the dollars that we have within our existing sales tax to ultimately leverage for more federal funds and ultimately expand the system. And separately, we'll be having a conversation around that. It is not our intention to roll that activity into the budget. We don't think that it's appropriate that that's all going to get answered before we need to approve the FY22 budget, but this just seemed like the right opportunity to begin this conversation with the board. That
Madam Chair.
works for you,
Madam
Brad?
Chair.
Yes. Are you finished, Mr. Parker?
Yes.
Go ahead, Mayor Floyd, please.
Thank you. This is really a comment or question for Jeff. You mentioned conversations with jurisdictional partners, and I think that's absolutely important, but there are a number of projects on this list that cross jurisdictions. And a couple of them involve DeKalb County, one south DeKalb, one north DeKalb County. And I think there's got to be a way somehow that we communicate between jurisdictions about conversations with those projects. Now, with regard to those projects in particular, the one in North DeKalb crosses about 5 or 6 different municipal jurisdictions and some unincorporated areas. Under the new Relief Act, which the cities and the counties are getting a lot of funds, that money can be used for transportation issues. As a matter of fact, under the act, a city can even transfer money to another approved, if you will, transportation entity, such as the Department of Transportation or MARTA. At least that's my interpretation of what it says. It would be my suggestion that you, MARTA, put together a list of these projects and how these cities might be able to contribute some of that money to seeing these projects move forward. If you're looking at the line from the Microsoft development in West Atlanta to Tucker, I mean, there are 6 or 8 municipal jurisdictions there that would certainly be interested in considering contributing funds to moving that project along. And I think if that's going to happen, it's going to have to be MARTA put together and ask, okay, we need for you to do this in order to help us move this along. I think that's something MARTA ought to be doing now or considering now. And I guess the gist of my conversation is, or my question or comment is that, look, if we're going to do these jurisdictional conversations about these projects, sooner rather than later would be my suggestion.
Yeah, that is our plan. Our approach will be to start with our board, to reach out to our jurisdictional partners and with the support of our board, but also to have our board, not just think about this from the jurisdictions that you represent, but from a system perspective as well. That I know you all think about both, and then I think the next step is to begin working with municipalities to talk about funding opportunities. I think we've heard a lot of that, particularly on the I-285 express lane bus system, and we want to engage in those conversations. And the very, very last slide and the concept behind that is really explicitly a way to begin to have those conversations in a meaningful way. I just don't want to get in front of the board and designing the potential investment, in front of the board as a whole. So we will move quickly. This is an important opportunity in front of us.
Okay, Madam Chair, this is Rod Fryer's question.
Go ahead, Mr. Bryson.
Yeah, my question had to do with, and I know I maybe should have brought up, we got to slide 28. When we talked about the funding for the station rehabilitations of $45 million for 2022, I was just wondering, is that projected budget an increase from 2020, or because clearly I know that we didn't execute those things in 2020, and I was wondering if the budget remained flat or was there an increase? And then also was glad to see that on your slide for expansion, that there would be some added money to station rehabilitation that would bring it to 100 million. So that's my question concerning that slide 28.
Yeah. So Larry,
Yes.
You may have more details about this, but I believe it's level funded. The commitments that we've laid out in our 15th Amendment are still what we're working towards, and this 10-year funding, as well as the FY22 funding, is designed to support those commitments in the 15th Amendment. Is that right, Larry?
Yes, that's correct. And so this past year was kind of the first wave, so the initial kickoff and getting started. And so the increases going forward are some of the rollover that we didn't get to as we were starting off this year. We'll be going into next year with wave 2, as well as additional projects within the 15th Amendment that we are in-house doing the A&E portion and giving it directly to CMARS directly right off the bat.
Okay. Well, good. And I would like to see some type of detail on the right now what projects are in this station rehabilitation plan project list to see where we're at on timelines. Once again, that's something that we had promised in our jurisdiction that we would see in DeKalb County, and we want to make sure that once again there's adequate funding now that we see our revenue planning to increase for 2022, and then once again the priority of that project list. But that's something that we can discuss. All right. Thank you, Mr. Prescott. Thank you.
You're welcome.
Madam Chair, this is Chris Tomlinson.
Yes, Mr. Tomlinson, please go ahead.
Yeah, just a comment and 2 quick questions. One, again, I just wanted to state that echo what Jeff said. We've had some, I think, good conversations between MARTA and ATL staff, and look forward to the future conversations. Raj, I think you did a fantastic job, and Jeff, I think there's a lot of very interesting things that you've laid out, and I definitely see the vision. The question is, the first short question is are we on track for a budget adoption? I guess it's both capital and operations, I guess committee in May and board adoption in June. Is that about right?
Yes.
That's correct.
Okay.
Yeah,
And then,
so we're moving ahead on that. Just to be clear, and hopefully I have been, is this discussion about the 1.6 to 1.8 billion dollars is not not going to have to be resolved in order for us to adopt an FY22 budget. So those conversations will go on in parallel. And as we land on the priorities that ultimately the board will approve, we will incorporate those into future budget requests to the board.
got it. Makes a lot of sense. And the second question, if you can go back to that very last slide.
Yep, the page 37.
Yeah.
And we'll get this. We will get this table out to everyone. It wasn't included in your submission that you received, but really because we were just continuing to work on this. So go ahead, Chris. I'm sorry.
No. My question is really just the last column. I mean, I think I followed most of the table, but I didn't really understand the currently available column. I just didn't know if there was a little more clarity on.
Oh, yeah. So those are those are funds that we've already allocated. Like, for example, the $1 billion there is, an approximation of what the half-cent sales tax for the City of Atlanta is generating for the More MARTA City of Atlanta project. If you go down to the MARTA station rehab, I'll just, describe that one because Mr. Frierson was just asking about it. So on the slide that we just saw, that showed that over a 10-year period, we've allocated $371 million to all of those station rehabs. What this potential allocation of funds would say is that we would be adding $100 million, and we would have an additional $100 million to improve the station, make the scope of work that we could deliver with our station rehabilitation projects that much bigger. Does that help, sir?
Yeah, I think it helps. I seeing that billion in existing, it begs a little bit more conversation. So I think that's helpful at all. So thank you.
That is, that big number is the City of Atlanta half-cent sales tax. What that's generating.
10-4. Thanks, Jeff. Thank you, Madam Chair.
Yeah.
Thank you. Are there any additional questions for the presenters or Jeff, or any additional comments? Hearing none. No additional questions or comments? Thank you. We'll adjourn the meeting.
Thank you.
Thank you all.
Thank you very much.
Thank you very much for the presentation.